G'day everyone, welcome to the weekend general update for the 8th and 9th of June. And June is typically a time of the year when markets get a bit shaky, so it's not at all surprising to see the fairly negative sentiment that's suddenly crept into markets globally, but also particularly into the Australian market. And it would appear that we're getting some significant selling from overseas hedge funds, particularly in our banks and higher yielding stocks. Part of that is the Australian dollar falling, so people overseas are not wanting to lose advantage on the currency, so a lot of money is flowing out of Australia. It's hard to tell when that process will find a new level, but what is happening is that it's setting up tremendous opportunities. So let's get on and have a look at the week of action that we've just had. The S&P ended up rising 13 points on the week, but it did dip significantly before that. And if you recall from previous weeks, I had a target band, or a first target band, of between 1600 and 1620. It touched 1598 before bouncing very hard on Thursday and Friday. Now, a third leg down still remains a very distinct possibility. In my mind, it's probably 50-50 whether we've seen the low point or whether we're going to get a lower low at this stage. So 1600 to 1620 has been fulfilled. If that doesn't hold, then 1555 is the next level. But look, we're still in this situation that I've been talking about all year, which is any correction is going to be a relatively good thing to get rid of the excess, and it's going to be fairly shallow and fairly brief as well. Now, the important thing is that there's no signs of a trend change in the broader market, and that's really important. If this was more of a significant top, as a number of commentators are starting to point to, then we would be seeing the broader market already turn down, and we're just not seeing that. And I want to highlight a couple of charts here. This is new highs, new lows index. Now this is on a daily basis, and we're looking at the last 4 months. So that's February through to June of this year. So you can see that whilst it's plateaued out, there is still it's still basically rising. Now it may turn over from here and go down, but I don't think so. But at this stage, there is no sense that that this upward momentum has really turned down, because the stocks were still getting higher readings in this new highs, new lows index. Let's take a slightly wider view and look at a weekly chart of this. So we're now looking at basically the last 2.5 years. So you can see just the extraordinary rise that there's been since 2010. Now we've had one pullback in September, October of 2011 when things got a bit nasty. Not so much in 2012, but that really just does give you a sense that there's a lot of stocks that are still heading up. Now this is the US market, of course. Now, just a bit of a word of caution. Japanese bonds are under very, very significant pressure at the moment. How that plays out will be, to be determined. It's pretty unclear how that'll play out. It never seems to play out the way that people project. But the circumstances that have allowed Japan to run these unbelievable debts, which as a percentage of GDP are far in excess of Greece and Spain and Italy, those circumstances are shifting. So that certainly is a dynamic that that needs to be watched fairly carefully. Now let's have a look at some of the charts. This is the S&P 500, and we've been looking at this trend channel now for quite a few months, and the two areas that I was looking for was a slide down to the bottom of that trend channel and then a reversal back up, and we've certainly had that. Now the question is, will it just go straight back up to the top of the trend channel from here, or will in fact we get a break of the trend channel and come back down here to this 1555 support level, which is highlighted by this green box? I'm 50-50 at the moment. I don't really know which way that's going to go. I suspect if I had to toss a coin, I'm not prepared to take the risk that this correction's over. I think we might get a bit more yet, and that'll just set up an even better buying opportunity for us. The RSI not quite unwound yet, and at some stage we've had 1, 2, 3, 4 drives to the upside. At some stage you have to get a correction, a correction of that whole move rather than just minor corrections of each little drive to the upside. So that's why I think we're overdue to get a more significant correction of that move, and coming back to 1555 would certainly fulfill all the things that I'm looking for. Now let's just have a look at the Russell 2000 index as well, which is another indication of the strength of the broader market. This is the small to mid cap stocks, and you can see there's no real sell-off there at all. So in America there's just no signs that this significant momentum is waning. If it was, this index would be rolled over well and truly by now. We'd have lower highs and lower lows. That's just not happening. So that's why I don't think this correction is going to come to anything more than what I've said it would be all year, and that's brief and relatively shallow. Now let's have a look at the Australian market, and we'll start with the banks, with the finance index. Now I was looking for a level of 51.46, which also corresponds with the 150-day moving average. You can see the RSI significantly oversold down here, and the banking index got down to 51.49, so within 3 points, which is like 0.1% of that target that I had. Now whether this is the low point or not, I'm not sure, but I would expect to see probably a bounce from here, and the nature of that bounce will tell us a lot about the strength of this downtrend. If it's a fairly shallow bounce, then look out, the banks are going down further. But if the bounce is fairly solid, then they're probably going into a sideways trading range that could run over the next year or two. To be honest, they've had an unbelievable run. It wouldn't be surprising now to see some sort of broad trading range. But that trading range is likely to be wide enough to actually be quite tradable. So looking for opportunities in the banks. Just moving on to this is the ASX 200, and for members we managed to get a terrific short trade out of this. We picked up 250 points to the downside, and that's been a great trade. Now I was looking at 47.65 to 47.90 were the areas that I was looking for. We actually got down to 47.32. Now our market obviously closed on Monday. There'll be another US session, so we don't really know how our market is going to trade, but certainly it's setting up to provide some really good opportunities, I believe. This is the materials index. Was outperforming. We had materials index going up while the banks were going down over the last few weeks, but it took a bit of a hit last week, as you can see, down sharply. And if we look at our small cap index compared to the US, this has just been absolutely monstered, and we're now basically at low levels that we haven't seen. We've got to go back. It's similar levels to March of this year, but beyond that you've really got to go back to the depths of the GFC to get lows like we've seen. So the small cap sector has been absolutely smashed in Australia, and that's in stark comparison to what's happening in America. So our market's certainly under a lot more pressure. However, the quality companies, the really good companies, they're also pulling back in price, but they will be the first to stop falling. They'll be the first to turn back up again, and we're starting to see some real value emerge now. So I'm really excited about the opportunities in the best companies that I've identified on the market. Now, so the ASX index ended up falling 190 points on the week. As I said, the banks are down to technical support. How much further the hedge fund selling has got to go, no one has any idea on that. So we'll just have to wait and see how that plays out. But we'll certainly be able to gauge it from the price patterns. The other shift that we are seeing in the market is that from the middle of last year up until just recently, people were only interested in dividend yields. They weren't really that interested in stocks that could provide significantly growing earnings. But that is now changing, and people are getting a bit more risk tolerant. So what they want now is the dividend yield, but they also want stocks that can grow earnings reliably above 15% per annum. So a lot of those stocks are coming back into favour, and that's just playing perfectly into the sort of stocks that I'm looking at. Now, gold lost $8 on the week. It did trade up positively to resistance for the second time. Again, it's a toss of a coin which way gold goes in the short term, but longer term, my view is still unchanged. We'll see gold above $2,000 an ounce and probably well above $2,000 an ounce. I'm surprised it's taken this long, but I think eventually we'll get there. Gold stocks certainly starting to look a little bit better, and also in other commodities, copper still holding around 328, and oil rose to $96 as the US dollar slipped towards the end of the week. So let's take a look at gold and silver. So this was gold on a daily chart. You can see it had a bit of a fall on Friday night, but basically it's just been in another one of these sideways consolidation phases for a period. If we look at gold on a weekly chart, you can see hasn't really done much since the crash in the price we had in mid-April. It's really just been going up and down in the one spot. But importantly, and I've been saying again, another dynamic that you need to watch closely is that the gold stocks will turn before the price of gold does, generally 3 to 6 weeks in advance. Let's have a look at this is the GDX index. You can see it would appear that it stopped falling. It's been falling for quite some time, basically since about October 2012, and it appears to have stopped falling. We seem to have got a base forming there now, and if we go to this this division between the price of gold stocks, the GDX index, and the price of gold itself, you can see this ratio has been falling sharply for some time. That means gold stocks going down faster than the price of gold itself. That finally seems as though it may have ended with that ratio now popping its head up above the moving average. So that hasn't happened for a long time. Now, it doesn't mean that gold stocks will just go straight up from here, but what it means is that we're probably in a transition phase. Whether that transition phase is brief, as in a couple of weeks, or whether it takes a few months to play out, I obviously don't know the answer to that, but I certainly know what it looks like, and I can tell you that 95% of the time we'll see gold stocks turn up before the price of gold actually finishes falling. So don't be put off if gold falls a bit further yet, because we've got some very, very good Aussie gold stocks, gold producers. Absolutely stay away from the exploration stocks. They're in a lot of trouble. Stick to the best 3 or 4 Aussie gold stocks, and I think there's terrific upside in them over the next 12 months. This is the spot copper chart. As you can see, hasn't really done very much at all over the last 3 or 4 months. So from a strategic point of view, we've got the highest quality stocks in Australia that have been overvalued. So the formerly overvalued stocks are coming back into the range. And a few have now got below what I believe is true valuation on my assessment, and there's a dozen or so others that are starting to look far better. So that's why I'm really excited about the period that we're in now. Now, turning to the banks, they're likely to go into a broad range for some time, but I think we could see some very tradable bounces in the banks as well. So this may be the best opportunity to make money at the lowest risk with the highest probability this year. The typical weakest times of the year are May, June, and then we normally see a bit of strength in July. We can get another dip in September, October, but this could very well be the best opportunity that we've got this year. So my advice is to you, don't miss out on it. The big picture over the next 6 to 24 months with regard to the sentiment for stocks is excellent. I think there's a lot of very positive things in place, and this is the time to take advantage of the people who don't understand about quality and value, the people that want to sell stocks when the price goes down, and they just don't understand that they're selling good stocks that are now down to good value, and all they need to do is basically hold on. So we're looking to buy stocks from the people that are selling them. So exciting period. Stay tuned. Talk to you next weekend. Cheers.